I'm excited about a couple of things for today and tomorrow. One is that being in person with you all, after not having been able to do things like this for a while, is very exciting for me, so thanks for participating. I'm going to go through a couple things. The goal here on these first three slides is just to give you an idea of what we're going to try to accomplish. Thank you, by the way. I kind of tried to strong arm the people in the back to come up front. Thank you for doing that. I want to give you an idea of what we're going to try to accomplish. And I want to say at the very end of tomorrow, I have almost an hour carved out for Q&A, but I don't want you to think about like, oh, okay, I need to write down my question, I need to wait until tomorrow afternoon. I would love for this to be conversational, so several times I have intentional questions where I'm going to like pull out some conversation, but if I say something or we're like flying past something and you're legit like, I want to ask this right now, or I don't understand that, or I missed that, yell, or if you're not comfortable yelling, like seriously raise your hand. I want that type of interaction, so please do that. If you feel like it's something that is maybe kind of a tangent, maybe note that, and then we'll have a good chunk of time tomorrow, okay? So, I want to tell you three things that we're not going to do. There we go. Be embarrassed by our lack of knowledge. This illustration is something that a mentor of mine, who I'll reference several times, laid out to me years ago, and it's impacted my life in a number of ways. But one of the things that always struck me about him that I admired was I knew how smart he was and how successful he had been. Yet, most of the time when I observed him in a room, he wanted to come across as the least knowledgeable person in the room. And it didn't even matter what the topic was. He wanted people to assume he was the least knowledgeable. And I actually asked him about it one day. I said, why are you always underselling your intelligence? And he said, well, I don't know that I'm underselling my intelligence, but I've learned this. I can't get smarter if I always want to be the smartest person in the room. And this illustration, I think visually, this is really helpful for me. Think about this blue circle as the amount of knowledge that you have. And pretend that the entire screen is like all knowledge. That's like all the things you could know. Okay? All of our circles are actually probably a lot smaller than this, but we couldn't see them. Right? So this is the amount of knowledge you have. The entire screen is the total amount of knowledge. So anything that's white, you don't have that knowledge. You all see that the circumference of the circle is the number of things that you don't know, but you are now aware that you don't know them. You follow me on this illustration? Which of these two people has more knowledge? This is obvious. Thank you, Crystal. Yes, this person has more knowledge. Which of these two people has more unknowledge? Yes. They are more aware of the limitations of their knowledge. And they are likely, because of that, more confident and secure in saying, whatever amount of knowledge I have, that is what it is. Like in this moment right now, you can't change it. What you can decide is, I want to grow my lack of knowledge. And this mentor of mine, I think this was his attitude in a number of ways. And it was a refreshing, like, I think we can feel a bit of embarrassment or shame sometimes about lack of knowledge. And I think financial literacy is one of the arenas where we maybe feel this more deeply. And so I'm going to ask you, if you will, until tomorrow at 3, commit to, I'm going to let that go. Because if you have a lack of knowledge in financial literacy, and that would actually negatively impact someone in this room's view of you, that's their immaturity. Like, it has nothing to do with you. So, you don't have to commit to holding that past 3 o'clock tomorrow. Hold to that. Yeah, Billy.
Really quick before we dive deeper, can you show the Wi-Fi password again?
Oh, yeah. It's just Laurel-Guest.
Laurel-Guest. Second thing we're not going to do is run a slimy get rich for yourself scheme. There's a lot, I know that. I thought about removing a couple of those words, but we're going to talk about wealth. And I'm actually going to be pretty open about some numbers. You all can decide if you want to be pretty open about some numbers. But I want to be clear about this because even I was thinking about it, several of the books that I'm going to recommend, the titles of the books I don't like. They like kind of make me shudder a little bit. This is a topic where you can get some pretty strong feelings about what does it mean to be rich and why would you be rich and what do you do with that? So I just want to address it and say, well, the point of this isn't just for your own good outcomes. I think the point of financial literacy is much deeper than that. And look, here's the reality. If you're sitting in this room, you have resources and opportunity that many, many people don't. Okay, and we're all over the place in this room on that, admit it. Just so you know where I'm coming from, I think resources and opportunity give you responsibility. And all of our responsibilities don't look the same, right? Mine is not yours, yours is not mine. But my philosophy on this is if you have resources, you are responsible to be as wise as you can with them. What you do with the resources that come from that wisdom is your decision. And I actually think if the thing that energizes me the most about this, and this mentor of mine that did this for me years ago, I think the same thing was true for him. I knew him, by the way. I was working for a nonprofit organization, and he was our largest donor by a mile. He basically paid my salary. So that's how I knew him, and that was the person that mentored me in thinking about this, which I think gives you a good example of all of his wealth creation wasn't simply for his own personal outcomes. And if one or two of you from these 2 days changes your thinking and changes your patterns and becomes more generous to your neighbor, to your community, to your city, that would make this entire thing worth it for me. So we're not going to talk a whole lot about generosity other than saying wealth creation is not the same as getting rich for your own benefit. They can go hand in hand. I just want to point out that it's a really important distinction. Okay, number 3, we're not going to write this off as something that doesn't apply to you. I'm going to give you a couple examples of things that you're either thinking right now or you might be thinking at some point in the next 2 days. Probably not all of you, but some of you. I don't want to be that person. I don't want to be the person that just cares about money. I view it as perhaps morally or ethically preferable not to be the person that cares about money. I'm going to ask you to table that for 2 days. If you decide to go back to it, your prerogative. I don't have any money, so what's the point? A lot of what we're going to talk about, you're going to feel like this only matters if I have money, and I don't have money. Table that, because this does apply to you. It may actually be the highest level of importance that you will ever have to be thinking about these things. I'm not smart enough. Not true. Bullshit. I will call that bullshit and say, yes, you are. If you're in this room, you have the intelligence to grow in your understanding and management of financial resources. Do we all have the same levels of intelligence? No. But don't compare yourself. Think about where you are and where you could be, okay? I don't have the time to change something. There may not be a room of busier people, I understand that. And time is a huge factor in this, but I also don't believe that's true. And one of the reasons for this is that financial literacy is likely the most powerful time leverage tool that you will ever learn in your life. So if you think about educating yourself about financial literacy as something that you are spending time doing, I messed up somewhere. Because understanding financial literacy, you are investing time that likely is going to be the best leverage of that time. So this works over the course of your life. It actually saves you an incredible amount of time, okay? 3 things that we are going to do. I want to have fun, and I feel like Joel started this off on this well, so thanks for that, Joel. I love to laugh, and if we get to be in person, why not do that? So we're going to do a little bit of that. Second thing I want to do is I want to open your mind to a new way of thinking. So I'll give you a heads up that a lot of this is going to feel like a little bit up in the clouds, kind of ethereal, philosophical, but you have to start there. Financial literacy isn't simply math. There's a big component of it that is understanding math. You have to be able, or you have to be willing to change the way that you're thinking about something. So that's the second thing I want to do. Third thing, I want everybody to walk out with 2 achievable action items. And yours aren't going to be the same as everybody else's. I'm going to give you a lot of examples of what your achievable action items might be. And I want everybody to have 2 because, I'm teaching this. I should be able to walk out of here understanding 2 things that I can work on, 2 achievable action items that I can do that are worth doing. And there's somebody in the room, but this is the very first time they've even thought about financial literacy. So both of us should be able to think of 2 achievable action items that we're going to commit to doing. Okay? And I am, at the end of the class, y'all are going to report back on what those 2 are to the group. So if that helps you, that if you're thinking about what my 2 achievable action items are, then great.
We
And
have
after,
to tell people that.
the very Crystal's not coming tomorrow. Okay, so the problem, to kick this off, the premise of the whole thing of talking about financial literacy to a group of adults is I believe it's lacking, okay? That's the problem. How did we get there? Well, I don't have great explanations on the why to this, but I'm a reasonably educated person. There are many of you in the room who have more college degrees than I do, but yet we have kids going through elementary, middle, high school, secondary education, graduate degrees, without ever having coursework on basic financial literacy. We can talk about the why. I don't know the answer. That's not a conversation we're going to have, but I think that's a part of how we got here. So I don't know. We're going to talk so many things other than that. I don't know of a school curriculum that truly teaches students how to think about money. I have never come across it. I'm on the board of a high school here in town, 2 high schools here in town, and I asked this question, and I still don't even really truly understand understand the answer. We're not gonna talk about like, are we gonna try to fix that? No, not in this room. That's a part of how we got where we are. And if you're thinking like, wait a minute, we talk about money in school. My experience and what I have observed is that we talk about budgeting. A true understanding of money, no. Okay? What I think this has led to is that, what you're thinking, hat on, this is where it starts to get philosophical. The primary way in which we have been conditioned to think and talk and behave about money is in 30-day periods of time. Okay? So that's budgeting. That in a 30-day period of, and we use 30 days because that's just how it ended up happening, right? In 30-day periods of time, you make so much money, and then you budget that money. Okay? Versus what I'm talking about is a lifetime wealth. Okay, you're going to hear me use the words wealth or net worth. Thinking about money for what it actually is, which is, it's just it's a vehicle to exchange assets, right? Could be time, more often it's actual physical assets, but money is just something that's used to exchange them, and that I think a true understanding of assets, you have to understand the concept of wealth. Okay, so we won't talk too much about the why, but this is the difference in perspective. So I'm going to give you a couple examples to help you understand this. So you can hear people talking about cash flow versus wealth. When you go in to buy a car, my family's been in the car business for 3 generations, still are. So I don't hate all car dealers. A lot of them, but not all of them. When somebody tell me, when you go in to buy a car, what does the salesperson ask you? Who said that? This is part of it. Have fun. Sorry, Crystal. Billy's right. So what's your monthly payment? What's your budget? And what do they mean when they say, what's your budget? They don't mean, are you going to spend $30,000? They mean, can you afford $650 a month? Okay? Hopefully, you're going to start to see examples of this. Okay? How do most of us define financial wisdom? So we go back to maybe if schools talk about this, what do they talk about? Or you hear in a lot of situations when someone says, good, we're going to see Rosie's email here in just a moment. If somebody says that in most situations, oh yeah, they're smart with their money. What do they mean?
They don't spend.
Is that you, Drew? Frugal. You're right. What do you specify that for me?
They
Yes.
have it.
They don't spend anything.
Yeah. They don't spend it. It's generally not about the leveraging of it or the creation of it. I would actually say, in a lot of cases, it means they know how much they make, and they ensure that they spend less than that. And look, I want to be clear, I wrote it up there, so there's evidence of this. I am not anti-budgeting. I do not personally ever budget anything, which can be frustrating for some that know me, Steph. It's not a part of how I manage finances, honestly. I tend to believe that budgets cause people to spend money that they shouldn't, and it causes them to not spend money that they should. But I'm not anti-budget. All I'm saying is that that is a surface level understanding of financial literacy. One of the books I recommend is The Richest Man in Babylon. Super One of the chapters in that book is I think it is called Grow Thy Purse to Fattening. Yeah, I'm telling you, it's very cheesy. So, one of the principles that is laid out in the book is like, spend less money than you make. That's step one. And the book kind of lays it out in such a way as like, the rest of this doesn't matter. If you can't do that, the rest of this doesn't matter. So it's important. And that's about all we're going to say about spending less than you make. That's not what we're going to talk about. Y'all know that. Probably learned it in 9th grade. Okay, a couple books that I'm going to recommend. Almost a year and a half ago now when we did this class, I actually had everybody read Rich Dad Poor Dad before the class when we talked about it. I didn't do that this time, but I would say this. There are thousands of books that have been written about this. There is a wealth of information. These are it's actually 5 that I have personally been impacted by. I've read all of these multiple times. And I could go back and read them now, because you don't arrive at this, right? You can always discipline your mind further. Rich Dad, Poor Dad, and Cash Flow Quadrant, they're 2 different books about the same author. And I would suggest reading them in that order. Richest Man in Babylon, Millionaire Next Door, and Think and Grow Rich. You see, Think and Grow Rich, that's one of the titles that is like, ugh. Get over that. Okay? By the way, I'm going to send these out. I'm going to send the slides. You'll get the slides. Thought about printing them out, but half of you would do what I would do with those printouts. So I'm not going to do that. No, go for you're going to get all these emailed. So my hope is that if you're, take notes, write stuff down, but you don't need to write something down that's on a slide. You'll get all these after. Okay? Okay, so financial literacy is just generally lacking. What could this look like, or what does this look like applied to realtors? Do you think of yourself as a salesperson or a business owner? And this isn't meant to be in any way a detriment to a salesperson. But what I mean here is that a salesperson thinks of themselves as someone who makes money over a certain period of time for utilizing their time and effort, right? A business owner does that, but thinks much more comprehensively and long-term, okay? Realtors are business owners, by the way, and the vast majority of them think like salespeople. Is your time the only way you can create wealth? Hey, at least for right now in our industry, we have an industry and a set of experiences and knowledge where your time can be incredibly valuable. You can make a lot of dollars per hour in our industry. So that's fantastic. But do you have any ways of generating wealth that do not directly rely on your hours? Most realtors don't. Do you think about client care as an expense or an investment? We're going to come back to this. It's just a little bit of an example. It's both, is the answer. But if you're thinking about it as an expense, you're probably asking the question, can I afford it? Or how much can I afford it? If it's an investment, you're probably thinking, is this working? Both matter. Do you have a tax strategy? We're going to spend a good amount of time on tax strategy. I was joking with somebody the other day that I think the IRS has to just hate realtors. Because I wonder how many realtors every April they get their taxes and they're like, where did my money go? Like, I owe the IRS $50,000. I don't mean strategy as in, are you putting money under the mattress to pay the IRS in April? I mean, a business owner is thinking about ways to legally mitigate what they actually owe in taxes. Okay, so we're going to talk about that. Do you own investment property? I'm continually surprised by the number of realtors that do not, and this isn't me saying all realtors should. My understanding of financial literacy and my experience in the industry would have predicted that more realtors would own investment real estate than actually do. Okay, we're gonna take, you know what? I'm actually gonna call this 5. So, take 5 minutes. I figured since we were finished with lunch, if you wanna like use the restroom, grab something else to eat or drink, do that. Heads up that our next little run of slides, it's a much longer one. So you're not gonna get a break anytime in like the immediate future. Cool?
Guys, trash cans are back here towards the back.
Okay, here we go. If this slide, if y'all will, if you read this slide and you're like, oh, I can't wait, then you're in the right place. If you read this slide and you're like, oh boy, I think you're also in the right place. Our first session, we're gonna talk about two of the three main financial statements, and I think if you want to categorize this, the way that I would categorize this is Exhibit A of how most realtors think of themselves as salespeople, not business owners. Is that we're in an industry full of business owners, and in most other industries full of business owners, if you said, describe to me what a profit loss is, or describe to me what a balance sheet is, they could do it. Because in most industries, to be a business owner, you have to have some understanding. So we're going to be all over the map here. Some of this is a little bit redundant for some of you. Some of it is brand new for others. But I think as a realtor, it is important that you have a basic understanding of these two documents, and then maybe even more important than your basic understanding of the two is the difference between them, okay? And then we're gonna talk about a personal financial statement. So right now, just think about profit, loss, and balance sheet, okay? So these are financial documents that businesses all over the world utilize. And I want to start by helping you understand what they are. We're going to look at some examples. Okay, so this is going to be a part where you're going to have to choose to be comfortable with your lack of knowledge and ask me questions. Okay, so please do that. And those of you that know the answer to the question being asked, encourage them by saying thanks for asking that. Okay, so we're going to start with the profit loss. Profit loss is a statement of income and expenses over a defined period of time. It shows you the net gain or loss in income over that period of time. So a profit loss could be a 1 month profit loss, it could be a 1 year or a 1 quarter or a 10-year profit loss. But to create a profit loss, you have to define some range of time. The one we're going to look at was an example. I think it was a 5-month period from 2017. And this is not a real one, it's a fake one. But so you think about there's a starting point and an ending point, and during that period of time, the business spent a certain amount of money, and it earned a certain amount of money. And it shows you both of those two things, income and expenses, and the net between them is the business's profit or loss during that period of time, okay? Pretty legible. So this is a sample. Sometimes you'll hear these called income statement or income and expense, revenue and expense. I've always called it profit and loss. I think that's the most common term. And you're always going to see revenue, the revenue category up on top, expense category below it. So you think that hopefully the bigger number up high, and then the expense number below it, netting to the net income. And so I'm just going to share some examples. And look, a lot of things about a profit loss aren't directly applicable to you as a realtor, but the reason I think it's worth going over this is it really does help you understand the difference between income and wealth. They're not the same thing. But to really get the difference, I think it's worth actually kind of doing a lot of that detail work and like, what do we mean by income? Okay? So, in this profit loss, you have sales. So in this business, 5-month period, they had $100,000. It's a nice, neat, round number, meaning customers paid them $100,000 for some product. This is a business that actually is creating something physical, because that cost of goods sold means they had $75,000 invested in the widgets that they sold for $100,000, okay? So you would say the margin in this industry, or for this business over this period of time, was 25%, okay? So they had $25,000 of gross profit. Gross doesn't mean disgusting in this case. Gross means before accounting, thank you, Andy. Was that laughing at that? Yeah. Just means before the expenses. So do you notice here the cost of goods sold, that's not called an expense? Why is the cost of goods sold? So let's say this business, let's say it's a food business, they make cheeseburgers and they sold 1,000 of them for $100, an expensive cheeseburger. And they had $75,000 in the actual meat and cheese and bread. Why is that not considered an expense?
Because they have to have it.
Yeah, it's directly related to the sales revenue, and it really, you'll see that the business didn't actually have $100,000 of sales revenue. They had 25. Okay, so the cost of goods sold is oftentimes delineated in that way. As a realtor, do you think you have a cost of goods sold? You're saying absolutely. There isn't a correct answer to this, by the way. Crystal, why are you saying absolutely?
You go ahead and get the correct. Well, we won't talk about it. This is what my CPA does, but I mean, your brokerage fees that you would never, that's a cost. That's really never your money.
That's good.
That percentage that comes
Yeah.
out.
Trisha, you were kind of shaking your head no.
So, yeah, because I got around about this, because I feel like the difference between cost of goods sold and expenses are two different things. So my brokerage fees, I would consider an expense, or even in this case, they're not really always counted even in my gross, when I'm reporting what income left in the bank account.
Yeah.
Those have already been extracted.
Yeah.
But listing photos, I was like, those are cost of goods sold or an expense? I think they're an
Yeah.
expense. So that, I feel like there's an interesting line when I'm trying to push it with the CPA, why isn't this cost of goods sold? They're like, don't bother, it's just an expense. So,
It's, the
yeah.
don't bother is actually pretty fair. In terms of how you would account for it, you see that, they have the same impact. It doesn't really actually matter to the net income line. I think the way in which most people differentiate cost of goods sold and expenses, realtors would not have any cost of goods sold. Because you're in a service industry. Most of the time in a service industry, they would just declare anything that you spend in your business an expense. So, it's just helping you understand what a profit loss is here. Then you get into this category of expenses. So, operating expenses, sometimes you'll see companies delineate between fixed and marginal. Have you ever heard about this? A marginal expense would be if there are things that they know are directly connected to how many cheeseburgers they sold, they're going to spend more money on paper bags, and so they would call that a marginal expense. A fixed expense might be an insurance policy that they have to buy for the restaurant. It doesn't matter how many cheeseburgers they sold; it's going to cost them $1,000. In this particular case, they're not differentiating that way, but generally you will see businesses try to categorize expenses, not because they have to, but because this becomes more valuable to them. If they can categorize expenses and come back and really quickly evaluate what percentage of our sales went to advertising, what percentage went to office supplies, they can compare to other people in the industry. So in real estate, there's also sorts of different things you can spend money on. Most realtors don't spend much money on things. We'll talk about that later. But if you did, you could compare what percentage of your revenue were you spending on things. You could also look at it then over periods of time. That was interesting. I spent 10% of my revenue in that category of expense in 2018, and I'm now spending 30% of my revenue in that category of expense in 2021. Why? But in order to be able to compare those, you'd have to categorize them and track them in a consistent way. And a lot of this, there's some guidance in terms of what you call them, or like how it's determined what goes where. But generally speaking, it's up to the business owner. So a profit loss is typically built by the business, and they decide how to calculate things. One little example in the real estate industry, some of you, if they're long enough, you remember when the IRS changed the law about how you deduct client entertainment. Anybody remember this?
Yes.
Can anybody tell me what the change was?
I know I couldn't have my Pacers tickets off anymore.
It's true. That is true. Does anybody remember what the actual rule was?
Was it a limit, an amount?
On a particular type of entertainment expense, they lowered the percentage of it that you could deduct. Yeah. Yes. Yeah, so what they said was, client entertainment, basically the IRS said, all these service and sales industries are writing off way too much client entertainment, so they kind of pulled that back and said, okay, these categories of client entertainment you can't write off anymore. You can spend it, but you can't deduct off of your income from that. And then in food, I believe it's now a half factor. So if you spend $20 to buy food for a client while you're with them, you can essentially declare $10 of that as a business expense. So that would just be an example. Again, we'll get to tax strategy, but that would be an example of like why you might, in your profit loss, call out, what am I spending on client entertainment? Because you're gonna have to back that out when you're doing your taxes, but you would still, in this context, declare that as a business expense if you wanted to know how much money did I really make. So you see this and what you declare in your tax return, not necessarily the same thing. So you have gross profit, total operating expenses, gives you your operating income, and these are non-operating expenses, so they're calling them operating and non-operating. You could see the marginal or fixed, depending on what industry they're in and how they called this. So these are actually interest revenues. This is probably a business that is not like a lender, but they must have some pool of cash somewhere that's earning interest. Like, this isn't what we do as a business. It just happens to be revenue that we got from somewhere. Kind of interesting that over a certain period of time they have interest revenue and interest expense. This one makes me laugh. Look at this, loss from lawsuit. So your total non-operating is 8,000, or sorry, it's 6,000. So in the day-to-day operation of their business, over a 5-month period of time, they made $12,000. In non-crucial operating activity over that 5-month period of time, they made 6,000. So in 5 months, they made 18. Hopefully nobody is relying on that business to fund a lavish lifestyle, but I am happy to spend as much time on this as we need. I'm also happy to go to the balance sheet, because I think most of our conversation is surrounding the difference between them and getting your mind around that as a business owner. But let's hit pause for a second. What about a profit loss do you think you're still missing? Explanation was that good?
I think one thing, Mark, is when you talk about non-operating or other, there's an earnings before incomes and taxes that I think that I still kind of am like, which is marginal, which isn't? So, for example, a utility can go up and down. Your utility costs throughout the year, if you're looking at a 5-month time frame, it could be different in winter to summer. But then I think, well, wait a minute. And so I think wrapping my head around some of those highs and lows when you're looking at the total, and it's hard when I look at it at a 5-month time frame. I like to look at it month to month and then year to year, and so it makes it really harder for me to understand it when I'm seeing a snapshot outside of a quarter or a month.
Yeah. Yeah.
That was a layered question or statement, sorry.
No, yeah, they can be, right, the period of time that you choose affects what information am I looking at and how helpful is it? Because most things function off of 30-day, 1-month cycles. Most businesses have recurring expenses that happen every month that might go up and down, or a year. I don't really ever look at quarterly in any of the businesses that I track profit losses in. I pretty much look monthly and annually. And look, as a realtor, I'm not even going to suggest for the majority of you. I think it's a little bit different if you're running a team, but for the majority of you, regular interaction with a profit loss isn't vital for you. My starting point is I think you should understand what a profit loss is so that you can understand the difference between the PL and the balance sheet. Because to really be financially literate, you have to. So this is, don't think of this more as like, okay, but what do I need to do with this? Right now, this is more like, oh, okay, I comprehend it. A really good CPA probably takes care of a lot of this for you, and I hope this is going to be one of the 2 action items for a lot of you, is to develop a relationship with a really good CPA. So don't think in terms of, what do I need to execute here, as much as what do I need to understand. Okay? All right. The balance sheet. The balance sheet is a statement of assets and liabilities at a particular point in time. So to produce a balance sheet, you are selecting a moment. It's a day. You say, as of January 1st, 2022. It is not a period of time, it is a point in time. It's a statement of assets and liabilities. Another way to think about that is it shows in one column everything that the company owns and what it's worth. And then in another column, it shows everything that the company owes, and in some cases, what those things are worth. Usually the O column, you don't have to delineate what it's worth because it's actually already got a dollar amount tied to it. So balance sheet, moment in time, calculates a company's net equity. So the net between the 2 columns is a company's net equity. For an individual, you typically call that net worth. These terms are kind of interchangeable. Normally with a company, say equity, individually, say worth. Okay? What do I own and what do I owe? Can the balance be negative? Yeah.
Very nice.
Yeah.
I said very easily.
Yeah. Most, I don't know about most businesses. Most people in the United States between the ages of like 22 and 30, it's negative. Why? Yeah. This is really great. I'm actually glad that Sarah said that. Most of the people who are between 22 and 30 that have a negative net worth, are they poor?
No. Knowledge-wise, no.
Bullet their lives typically look like?
They're in debt.
They're in debt.
Student debt.
My point about the word poor has, you could make up as many definitions as you would like. So you have to get really specific about that, but, great example. 29-year-old physician.
Debt.
Most
Negative net.
Most 29-year-old physicians are probably making really good money,
Negative net.
living in a nice house, and maybe by that point driving a nice car. And their net worth is likely negative.
Yep.
So the word, you see what I'm saying? The word poor, we're going to come back to the that's income and net worth and the difference in how the two interact. But I want to point out this just about the balance sheet, that if you're taking a snapshot in time, whether it's positive or negative, doesn't necessarily give you a whole lot of information about how that business is performing. You follow that? The profit loss is how the business is performing. The balance sheet is more of a what is its financial status? Okay? We could talk about I thought about looking at balance sheets of publicly traded companies that everybody would know the names of. It gets a little bit into the weeds, so we're not gonna do that. But I think it is interesting when you look at businesses that have incredibly strong balance sheets, but are, from a profit loss perspective, performing really, really poorly, or vice versa. That's fairly common, and kind of industry to industry. But I think as a realtor, as a business owner, and just as a human being with financial opportunity, I want to make sure that you understand these two things, because as we start to talk about the difference and get into financial literacy, I think this is a starting point. You all see how the profit loss, before we get back to that, I want to actually go through the balance sheet, and then I'm going to circle back to one of my things. Joel, go ahead.
I was gonna share an anecdotal story with a little humor, since you want to have fun. So when we started buying rentals, and we've kind of bought a few now, but when we first started doing that, we were putting so much money into initial acquisition, renovation costs, to where if you looked at a balance sheet, it was either flat or it almost showed negative. And I remember a couple years in, my wife was like, "You've made us poor. Are we poor?" It's where's all the money at? And it's it was performing well, but you couldn't show anything, because it was you're in that rapid improvement stage. So that's just an example for me.
Yeah. Maybe the best way to say this is that understanding these two concepts and the difference between them will be one of the keys to you making really good financial decisions for the rest of your life. I'm not overstating that. And I don't mean really good financial decisions in the don't overspend compared to what you make. I'm assuming that's true. I'm talking about investing the resources that you have in your business or otherwise. You've got to understand these. So, example of a balance sheet here. It's a little bit blurry. Hopefully you can see that in the back. So the left side is the assets. They're things that a company owns that are worth something. Right side is liabilities. These are things that the company owes. As realtors, we don't actually usually have balance sheets. So as we go through this example, you're thinking about, what would this be for a realtor? I'm going to get to that. Because realtors don't own the product, right? This company this is not the same company, by the way. I don't think it's a real company anyway, but they currently have $2,100 in cash. Petty cash would mean actually in a drawer somewhere. They have an additional 100. So I'm going to go pretty fast here. But temporary investments, Accounts receivables, that's money that is owed to them. So it's debt that they own. It's not debt that they owe, right? So they probably sold some things that customers haven't paid for yet, $40,000 worth. Inventory, think cars, think Target with the stuff on their shelf. This is the product that they're trying to sell that they have in some form of inventory. Supplies, this could be office equipment, things that they're not trying to sell, but they do actually own for the purpose of the business. Prepaid insurance, you could have any sort of prepaid expense. A prepaid expense is considered, here's where these two documents kind of do this. If you have paid for something that will become an expense, but it hasn't happened yet, it's almost like it's still money. That's why it's in this category. It's not cash, but they have paid for $1,500 of insurance that they haven't actually used yet. They may have paid their 2022 insurance bill in December of 21 or something like that, and they're calling it prepaid insurance. In the next year, when they use that insurance, that will go from a prepaid expense here on the balance sheet to an expense on the profit loss. So they interact in that way. Investments, so this company appears to be some sort of manufacturing business. So this isn't inventory, this isn't equipment, this is bigger picture stuff. I do like the $5,500 in land and $6,500 in land improvements. Where did they buy their land? Or it's just really old, maybe. But you can see these are things that the company owns, right? Here's an interesting category that realtors or real estate brokerages do actually talk about at times. Maybe tell me what this is. It's Goodwill, is what it says.
Donation.
It's not the thrift store franchise. They're actually attempting to evaluate what their customer database and kind of good reputation is worth. Trade names is a bit more specific to a brand name. So this is something you could see but not feel necessarily. The trade name could be a brand value. Goodwill is like existing momentum or positive reputation. This is oftentimes comes into play when a business is being bought or sold, right? It's the example I always think about because of my family's involvement in it. 15 years ago, my family sold a car dealership. And there was like a kind of nationally agreed upon current goodwill value to the Ford name. So a buyer and seller are actually negotiating about what that is worth. Y'all see why that is on the asset column of the balance sheet? You also see how that could really quickly, yeah, how it could really quickly change what the equity of a business, like if you want the equity of your business to show up positive, like
Yep.
here's the brand or goodwill value of our business. That to say, I think it illustrates how either of these documents are only as helpful to the business owner as the business owner makes them. Because there oftentimes isn't like a defined, oh yeah, you just look it up on the internet, look up what your goodwill value is. Like, no, it's very subjective. As a realtor, I don't know of a realtor that has on their balance sheet attempted to calculate this. However, what is this for a realtor? Reputation
Referral.
and your client database. Yeah. I know people eventually try to value it because that's something that will sometimes trade hands. You don't sell. that sense, but, this is what a business would do to try to figure out what is the whole business worth, okay? I was thinking of this is one that came to mind. Angie's List. Because it kind of Indianapolis backstory. Angie's List, somebody correct me here, but I believe this is true. Angie's List never published a profit loss that had a positive number at the bottom. And then they sold the business to Home Advisor?
Home advisors,
Home Advisor.
Yeah.
Or does anybody remember the dollar amount?
crazy,
It's a lot of money. I think it was is it B?
yeah.
Was it B? Somewhere in there? Yeah. You all see that? This is basically what that illustrates for you.
Yep.
You'll see that Angie's List never declared a profit, and then sold for at least hundreds of millions to Home Advisor.
And then they sold it back.
Yeah, the whole thing's very confusing. But, okay, on the right side, liabilities. So this is what you owe. Notes payable, accounts payable, wages payable, interest payable, taxes payable, warranty and unearned revenues. Those are, well, okay, not the unearned revenues, but everything else there. It's just pretty basic stuff that a business owes, that they know they owe. They just haven't paid it yet. Okay? So that current liabilities isn't like debt. It's a bill that hasn't been paid yet. The unearned revenue is it's the opposite of the prepaid expense. It's a customer that prepaid them for something. And so right now, it's like, oh, we have $1,500 in our checking account, but we haven't provided anything for it yet, so we owe that customer that value.
Like a gift card? Would you consider that?
Yes. Yep. Long-term liability is probably more what you were thinking about in the like, what do you owe? This is like a debt that you have. This could be somebody that invested in your company in the form of debt, or a mortgage on real estate that the business owed, something like that. Yeah, it says notes and bonds. Accrued employee bonuses could be in this category. You know that an employee has earned $20,000 in bonus, they're not gonna get paid until December. It might show up on a balance sheet in that way. So, in this case, you got total liabilities of 481, total assets of 770. So the total equity there is 289. If you can gather that the profit loss, what it means for the profit loss to be over a period of time, and the balance sheet to be a snapshot, I am content. But don't be afraid to say, wait a minute, I'm still not tracking what that means. Thoughts or questions on these two? We really kicked in, talk about the difference. Okay.
I think the word payable always confuses me. Like, payable, what is that thing? Like, in this time thing, it was paid out?
No, you haven't paid it out.
Haven't paid it out, but you're going to.
And yeah, so because this is a balance sheet, it's a snapshot, this is money that you know you owe and haven't paid. Once you pay it, it becomes what? Right, it disappears from the balance sheet. When you pay we're looking for an example here that will work. Here we go, the warranty liability. It's money that they know they owe and they haven't paid yet. They just got a bill. When they pay the bill, the $1,500 goes away. What else goes away? Yeah, cash, $1,500. that doesn't change the equity. That's the point of the two columns, is that the actual activity of the business, so like paying bills, receiving income that they've already earned, that doesn't change the equity in the company. It's the operation of the business over a period of time where they're selling things for more than they're investing in them. That eventually, if you so if you want to think about how these two interact in another way, the profit loss is dumping equity into the balance sheet. So if the company is making $5,000 a month, pretty consistent, well then you would anticipate the equity balance is going to go up at that same rate. It might come in the form of added cash. They just start stockpiling cash, or it might not change the cash at all. They might, with that $5,000, be paying down the bond payable that they have. But it is still increasing. If the company's been making money on the profit loss, it comes to the balance sheet. If they're losing money on the profit loss, it still comes to the balance sheet, it's just coming in negative. Okay?
Hey Mark,
Yes?
I don't know if you've said this, but I may have missed it. This always confused me in accounting, was that assets equals liabilities plus stockholders' equity. Because I think
Yeah.
that's, at least for me, it was always like, what?
It is a little bit confusing because I think most of the time, if you just reverse the formula and said assets minus liabilities equals equity, that makes more sense to us, which is the same formula that you just said. It's just moving. Where's Cam? Cam can probably tell me the correct words to use here. Moving one of the variables from the right side to the left side of the formula. So just think, I own a certain amount of things, I owe a certain amount of things, and the difference between those two is equity. Okay? Okay, crucial difference. So profit loss shows financial performance over a period of time. Balance sheet shows financial position at a certain point in time. That's what I was about to say earlier before I was looking at the balance sheet there, but I think a profit loss tends to make more sense to us. It feels more intuitive because it fits the way in which we've been taught to think about money. You follow that? How much did I make this month versus how much did I spend this month? So as human beings, not businesses, but as people, I think we are kind of conditioned to think about money kind of like a profit loss. I had so much come in and I had so much go out. I just need to make sure that the difference between those two is positive. Right? And it's true. That's why I'm not anti-budgeting for a business or a person. So I think the profit loss tends to make more sense. The balance sheet is critical, though, to our understanding of wealth, it's a big sentence, as something that can be created, leveraged, and grown over time without directly correlating to our contribution of time. I'm going to read this sentence a couple times. So this is why it matters. A profit loss, especially in an industry like ours, it's a vehicle that relies on your time. Okay? A balance sheet, if correctly understood, helps your understanding of wealth grow so that you begin to think about wealth as something that can be created, something that can be leveraged, and something that can be grown that doesn't always have to rely on the contribution of your time. Okay? I'm oversimplifying a little bit here, but this, I think, is the understanding of wealth that is lacking. Is that understanding a balance sheet for a business or a person begins to retrain your mind to think about net worth or net equity as something that can be expanded, leveraged, and grown without necessarily the contribution through time. Those do not have to be correlated. And I think if you can start to embrace that and start to understand the difference between the two, then you're gonna, kind of for the rest of your career, you're gonna ask better questions about how to think about wealth. And I think you're gonna see, well, you're gonna see a number of things about the power of leverage and how to think about your business as it connects to your financial position, your net worth. And the two are clearly connected. I would submit the theory that I think for realtors especially, their profit loss performance and their net worth are like this. And in a lot of cases, it works out very well, because you can make really good money in this industry. But there is actually data that backs this up. We're an industry of people that have super high incomes and don't necessarily have strong net worths. And they work until they're 80. I'm not suggesting it's the only reason you would work until you're 80. But I think this is one of the springboards of that, is that they're not understanding the concept of a balance sheet, and so their concept of wealth is so stuck in those 30-day periods of time, like a profit loss is. Okay? Happy to move on, but I'm always pausing here for questions or comments.
Or
Anybody just
jokes.
love looking at profit losses or balance sheets. I know, I can tell. Tony does. Balance sheets and.
And Amanda, Amelia here is gonna join me. I love it, love it.
I was gonna say though, I'm sure a lot of people know about this, but my husband and I started using Mint right after college, to your point about like student loan debt and everything, just seeing our net worth grow. And it's been interesting, it's a free resource, so if you haven't heard of it, I'd recommend checking it out. But mint.com, you plug in all of your assets, all your liabilities,
Yeah.
and then it creates everything for you. And it is actually really cool to see your net worth just hopefully grow over time.
And then all your debts, and like, and you can see like what's, my husband and I use it too, and he loves it, and you can see like what's in the bank, well, even you can link multiple accounts, so you're able to see like, what do you owe credit card, like wise, versus like what do you actually have. I agree, it helps you see like, what's your total picture, instead of like, what's my budget for this month, you're able to see like, what do I actually own and owe.
Yeah.
And I think it's interesting, I'm a little bit of a geek on this, coming from a corporate background. But it's even better now for me coming from an independent, because I can pull all the levers personally and not knowing what I was missing in the balance sheet on a corporate level, because that is further down the pyramid or higher up the pyramid, and profit and loss was more on an individual snapshot of a single store.
Yeah.
And so now you have complete control of your business and your net worth and what you can do and not do, and it's pretty powerful.
Yeah. And if I think about, if y'all want two examples of how the understanding between these two things could be a big impact into your decision making, there's two really obvious ones that we're going to spend quite a bit of time talking about. One of them is leverage, utilizing debt to create wealth. That's what leverage is. The second one is tax strategy. That understanding the difference between these two is key. This is, I'll share later an example about my own journey, I guess you could say, but I remember the first year that I was like realizing this and kind of getting my mind around it. Like, not to make it about the numbers, but I'm okay being authentic about this. There was a year where I made $100,000. and I probably spent about $90,000. Okay? And my net worth increased by how much? Tanya spoiled it. What would be the obvious answer to that? If I made 100 and I spent 90, what did my net worth increase by? That would be the obvious answer. My net worth increased by 250. It was the illegal drug trade.
It's getting interesting.
Because this is the difference between profit, loss, and balance sheet, right? That I'm not like being cryptic about what I made. Like my tax return legally said 100. Okay? That is an accurate definition of what I made. So you don't have to answer the question now. We're going to come back to that example, but that if your mind's like, wait a minute, that gets the difference between these two. So you see why I'm kind of harping on this isn't just accounting class so you can pass a test or check a box. It's if you can get your mind around the difference between these two, I think it will eventually have massive impact in how you think about finances. Okay?
Quick question. How scared were you when you spent that $90,000?
I typically don't get scared of this.
Do you work with them at staff?
Ryan's question is a really good one. How scared was I when I spent the 90? Y'all, the answer to that question is a direct tie to how well I understand my balance sheet. The better I understand my balance sheet, and the better I understand that the equity was actually increasing much faster than what I was spending, the less concerned. Now, that you really are kind of going to dive into the the more you focus on your balance sheet, actually the more challenging that cash flow becomes. Okay, so we'll get back to that, but I think you're getting at a really good question.
It's been my hardest part so far.
Yeah.
It's taking the first step. Are you bringing a psychologist in tomorrow?
Okay, so bonus question.
Just to piggyback on that real quick before you move on. Like, what about your second 90? Were you less scared then?
Well, it's not like you didn't get shit on the first.
Yeah.
No. Yeah, I think the more. Honestly, I think the more you understand and leverage financial principles over the course of your life, the more you realize basing your spending off of what you're making is not ideal.
It's not ideal.
Not ideal. Yeah. And this is why I say about
Say it again.
budgets. Then I think eventually it is sound financial practice to base what you're spending off of what you think you should spend, not off of what you're making. So Joel, I think over time what happens is what you're spending becomes, I think, more a question of, look, there's a spectrum to this, and what I'm about to say, y'all, it's an incredibly privileged position that most people in the world will never have. Is to be able to think about, wait, financial freedom. That I don't necessarily have to base what I'm spending off of what I am earning in a paycheck or commission at this moment.
Right.
That is one, I think, a very good definition of financial freedom. And then over time, you're going to grow. And so, I don't think anybody in this room is at the point where they really, truly don't matter. There are some people in the world there, but none of us are there. But over time, you see how the gap between them can grow. We are going to come back to that, actually. Okay, this is a bonus question. I've been alluding to this, the answer's been up there on the screen, but I want to see the connection here. If a balance sheet is a document that a company produces that shows what they own and what they owe, what would that same document be called if it was created for an individual? Who said that first? Oh.
Quick intermission.
And I won't be catcher, we are looking for a catcher.
Which is unfortunate, after that display right there, it's unfortunate that you're banned from being catcher.
Now that's
Bring your
a
kids
fun
to our game.
You guys, I mean, some of you in the room know it, I'm not gonna give all the details, but I will just say that we had a company, softball team that was a lot of fun, and our catcher was
Ejected from a game.
heckling the batters of the other team. And she found out where the line was. She found out where the line was between everyone's laughing, and now not everyone's laughing.
It was not my fault, the guy was soft. At your house, and I mentioned it.
It had nothing to do with her being inappropriate.
I was in left field at the moment, thinking to myself,
She's gonna get beat up.
I'm gonna have to run it. I'm gonna have to run it from left field right now. That was a heck of a catch. Yes, okay, so a balance sheet applied to an individual is a personal financial statement. Sometimes you'll hear people use you could use them interchangeably. You'll hear people talk about their balance sheet, totally fine, terms are interchangeable. This is like kind of one of those key things to walk away with is your personal financial statement is vital to the rest of your life and your financial literacy. For a lot of you, this is going to be one of your 2 action items. Sorry, I didn't put the answer up there. Yep. Is that if you don't have a personal financial statement, no shame, no embarrassment. I guarantee you there was a day that everybody in the room did not have a personal financial statement. You're going to make one. That's going to be one of your 2. But it's the exact same thing as a balance sheet, but it's for an individual rather than a company. So it's a picture of personal financial position at a certain point in time. And I would suggest that vast majority of people, I'll just say the United States, but probably in most of the world, but in the United States, they may not actually have a document that accomplishes what a profit and loss does, but they probably have an idea. They have some understanding of their budget. So a budget is kind of a personal version of a profit and loss. You follow me on that? They know I make $5,000 a month. So I gotta have my spreadsheet set up to make sure that my rent and my car payment and my insurance and my food and all that stuff is less than $5,000. And they might track it really specifically, or they might not. But I think most people have a comprehension of it. I can guarantee you that most people in the United States have no comprehension of their personal financial statement. What's your net worth? So it could be a fun experiment on like an airplane. Wow, that's a personal question. What's your net worth? Most people in the United States, they don't know. They have no idea. And even if they have an idea, they probably aren't utilizing what the answer to the question is. What is your net worth? They're probably not utilizing that in any real way. And some of you in the room, I have pushed and pushed and pushed until you made a personal financial statement and sent it to me. It's not about me knowing the numbers. You're always welcome to black them out. But I've had people say to me, I don't want to do a personal financial statement because I know it's negative. what's the psychology happening there? Yeah, it's actually probably denial. Right, there could be a bit of denial. I don't want to see it. Or it could be what we talked about earlier about you feel helpless. What's the point? A PFS, I'll just call it PFS from now on if you're living. That is something that an uber wealthy person does because they have all this money to figure out what to do with. My personal financial statement is going to show my net worth as being negative $50,000. Why in the world would I do that? Why would I spend the time to put it in a spreadsheet? What's the answer to the question?
You have to know where you're at to know where you're going.
Thanks, Amy.
All right.
Yeah, you do. You have to know where you're at. To know where can I go? And at what rate and how. Yes, there is more ability to leverage a personal financial statement if the net worth is high, right? The document itself, and it's the decisions that it helps you to make, are gonna have higher payoffs or losses if the dollar is higher. That's just a fact. But, I said this earlier, I think the most important day in your life to make a personal financial statement, sounds cheesy, is today. Like, yeah, there is, because if you delay it, all that you're doing is losing time, right? So whatever your net worth is today, that was the most valuable dollar amount net worth for you to make a personal financial statement. Okay, so I'm going to talk a little bit about what the personal financial statement does for individuals, and some of this applies to realtors, some of it's more general. It's the ideal basis to make future business decisions. Again, early in your career, maybe as a realtor, you're like, what's the point of that? But I hear from a lot of realtors that are making decisions based off of cash position, right? They know I'm not utilizing my time the best that I could, but I don't have a choice. And I will often say in those conversations, you might be right. I'm not insensitive to the fact that like, that is a reality at certain times in certain places for certain people. But I would say I'm not convinced you actually know that. Because you're making decisions for your time based upon how many dollars are sitting in a checking account, which is one factor on a personal financial statement. I'm going to give you an example of this. I was talking to somebody one time who was nervous about being able to make enough money to meet their obligations, obviously understandable. And they said, well, I know if I could do this, it would be a better long-term decision on the use of my time, but I can't afford to. They owned a relatively valuable house outright. No debt. That's what I mean by outright. Do you see how that is a personal financial statement question? I wasn't going to tell them what to do. But I said, if you had a PFS, and I could look at it, and I could say, oh yeah, your annual obligations, you think you need to make $60,000 to be comfortable. I totally get it, right? So now you're feeling that pressure in a month where you don't make $5,000 and you're making decisions that you know aren't the best long-term use of your time. Now, you might be thinking, well, okay, sure, if I owned a house with no debt on it. My point is that the PFS is the basis. It is the ideal. It's not in some cases you can't make the decision off of the ideal. What do you think I told this person to think about doing? Open a home equity line of credit. I'm not saying go and borrow a bunch of money and just keep going further and further into debt and live off of debt. What I'm saying is you just said to me, you knew you weren't making the best use of your time for your long-term business outcomes because you were nervous about meeting $5,000 a month obligations. Okay, well, let's build a buffer. And In this particular case, I think a home equity line of credit was a very reasonable, wise buffer. But you see how the PFS is the basis. Just one example. Helps you escape the trap of thinking about money in smaller periods of time, i.e. like a budget or cash flow. That's what I'm just talking about. And look, you might make your PFS and say, okay, right now, it doesn't, the structure, the actual, what is true of my financial statement doesn't give me any escape right now. It doesn't give me any margin right now. You see, it still does this. This is why it's vital to make the personal financial statement, even if the number's negative. Even if it can't right now change your behavior, you might still have to grind away your time to make $5 grand a month because you have the obligations and your financial statement gives you no margin. But by making it, it changed your thinking. You now might have, to Amy's point, you might have some clarity as to where am I going and how can I get there to now my thinking isn't in that trap, how can I get my behavior out of that trap? Personal financial statement helps you embrace thinking about money for what it is. I mentioned this earlier, an asset to be invested. I think it's actually pretty interesting. There's data on what most Americans' net worth likely is, even though we don't report this. Most people don't know the answer. But what do you think the average net worth of somebody in the United States is? Anybody know this answer? Yeah, it's actually about right. It's a little bit lower than that. What do you think the average equity in a house is for a homeowner in the United States?
Today? Or last year?
Let's go with last year. Yeah.
20%.
Dollar amount, sorry, not percentage.
50,000.
It's actually a little higher. They're right about the same. Meaning, the average net worth of somebody in the United States is, if it's $70,000, the average equity that a homeowner has in their house in the United States is roughly the same. And that's not coincidental. That's because most people aren't thinking about net worth in a significant way. Owning a house, let's see, the reason I'm using this as an example, we always say this is realtors, right? It's a what? Owning a house is a good financial investment, right? It's the one thing that a lot of Americans do that kind of forces them into this. You know what I mean by forces them into this? They probably aren't like calculating what it does to their ability to retire or their long-term financial outcomes, but it's kind of been beat into them. It says, well, you rent, you're gonna have nothing to show for it. If you own a house, eventually you'll have an asset. It's literally the only asset that is worth anything or could be sold or is appreciating in value that most people own. I actually, just a little bit of an aside, as the percentage of people in the United States that can own a house, as that number keeps going down, which it is in Indianapolis, it is in the majority of the country, the percentage of our population that can afford to buy a house in their marketplace is going down. I believe these principles become more important. Do you see that? The vehicle that forced so many people in the United States into at least one significant investment asset mentality is going to be impactful for fewer and fewer people. I would hope there are are still opportunities for people to think about money as asset, and eventually own a house. But another conversation for another day about housing affordability. But if you think about that most people in the United States don't have a PFS, and if they did, it basically amounts to what is their house worth and what do they owe the mortgage. That's pretty much what everything kind of nets out to that. And fewer people in the United States are going to be able to own houses. What does that likely do to the have and have not divide in the country? It explodes it. Yeah. You can control what you can control. I don't want to dive too much into that. But my point in saying is, well, to tie it to real estate, but to illustrate, if the mentality is the personal financial statement only matters if there's a bunch of positive zeros on it, then it's kind of a self-fulfilling outcome. That I think rethinking this and saying, well, actually, when your net worth is close to zero is the most valuable time to spend energy on that. Okay, Rosie, can we hand those out?
Yeah, all three of them?
Yes. Okay, y'all help us distribute these. So what you're getting here, the profit and loss and balance sheet, they're just the ones that we looked at. You're getting a hard copy of those for a minute. And then you're also getting a blank personal financial statement. As you're getting these, I have a confession to make, and I want honesty if anybody noticed this. I sent an email out on Monday night. Oh yeah, I'm
You're
going.
gonna mess up.
Oh yeah, yep, I'm gonna mess up.
You are dumb.
Monday night. Huh? No. Monday night, I sent out an email reminding everybody about this class. And I was still on Arizona time, so it was like, I was in Indy, but it was 1:30 a.m. I'm working on this. I sent out an email, and it had a link to this template, personal financial state template that we used last year in this class. After I sent the link to the document, I opened it, which was, I should have opened it before. One person in the room, at one point last year, had gone into the Google document and filled out their financial information. So here, it's 1:30 a.m. I don't own the document. I don't have, Rosie owns it. I don't have the ability to edit the document. And I'm like, do I drive to Rosie's house right now?
I wake up at 6:30 in the morning to Mark, I don't wanna leave my children fatherless. Can you please, the first
Oh,
thing
you're
you
so
say,
lucky.
go in and take it off.
I was like, number one, proud of Sarah Beth, because it demonstrated that she made a personal financial statement. number two, but I sent the rest of it, it's like, I don't want to die yet.
So if you guys looked at that, I did buy an asset since then, so my, I'm not as poor as it's up to. I sound bad buying Chanel, but
No.
it looks like that.
I'm pretty sure Rosie got to the document and cleared it before.
No, Tyler saw it.
Tyler did! One person did.
No one else saw it.
Two.
See, you owe me a fucking bag.
I know. I kind of wanted to get it like out of the open a little bit so that there was this like, yes, I'm aware that someone has seen it. And I wanted to confess, I did it in a safe space.
Safe for you?
Where are you
Yeah, that's exactly right, safe for me.
Now we're all terrified to go ahead and adopt. Yeah, don't.
No.
We're happy you.
When I sent the document, like, last December of 20, in the email, I said, hey, don't edit this document, it's a shared Google Doc, copy it and do your own. Well, Sarah Beth transferred to the brokerage shortly after we ran the, and I think at one point I had shared it with her as a template and did not clarify those instructions, so I can take responsibility for it. What I'm kind of laughing at is that it went from March until February without me realizing that until I shared it. So thanks, Rosie, for deleting it before more than 2 people saw it.
I'm making an appointment at Louis Vuitton right now.
So you're welcome to use this to write on, fill it out here if you'd like. But I want to go over how this works. So again, if you don't have a personal financial statement, if you do not keep one up to date, I'm forcing this to be one of the 2 action items. Okay? If you do, then hopefully this is a good chance for you to be thinking about what are my action items in light of my personal financial statement, okay? So very similar to the balance sheet, but as you're looking at this, obviously you have your name and contact info. On the left side of your assets, right side, liabilities. Cash, pretty straightforward. Any form of cash account, savings, checking. Other cash could be like, well, I don't think you would call it this necessarily, but I could imagine people putting cryptocurrency now in that column. Notes receivable. Some of you might have this, but this is like money that's owed to you personally. Most individuals probably don't have something on this, but this could be like, you should lend money to family, but maybe a loan that you've given to family. This could be a, well, right now, here's a good example. We're seeing a lot of older generation lend money to younger generation to help them buy a house, to make up appraisal gaps, or to compete in multiple offers. If you were keeping up in your personal financial statement, the older generation would be writing this down here, unless it was a gift, and then it's gone. Capital stock or investment. So this is business owned. You may not own shares in any sort of business, but if you do, whatever the value of those would go right here in this column. Life insurance cash value. So this doesn't mean like what would your life insurance pay out. This is if you have a life insurance policy that has a cash value to it, you could claim, you could cash it in and get that right away while you're alive. Securities. This is where your retirement savings would go, or like a Indiana 529. Little side note, I just realized that I forgot to put this on my 2 action items. Maybe, if you're looking for an action item, one of them should be start an Indiana 529. State of Indiana is basically handing out $1,000 a year in the form of a state income tax credit to anyone that will start a 529 and contribute matching dollars. So they match your dollars in, and they contribute to that. So, big deal, especially with having a 529, it's money that has to be used for some form of higher education. But it's also
It
withdrawn.
doesn't have to be for higher education.
Education.
It can just be for education.
Yes,
For
sorry.
you can do it for private school too.
Yep, yeah. Originally, I think it was post-secondary,
Yes.
but they have since changed that.
And they can pass personal education.
Yeah, and it's not like restricted to a particular kid. You can, if you have a child, you can gift a 529. So like people that are like, I don't have kids, why would I need to save for education? You could save it up and gift it. It's essentially $1,003 a year. That just came to mind because I saw it on here as a security. Oh, you know what? Yeah, sorry, go to the back page. Looks like it's missing something. So you have personal property. So imagine this is one spreadsheet as you flip it over. Home furnishing and contents, jewelry, car. Y'all, the very first time I filled this out, with my mentor in Lafayette, and y'all can guess what the sum looked like. So I was pretty desperate. So I put in there like the furniture in my house, like 23-year-old me, that the furniture in my house was worth, I don't even remember what I put in there, maybe like $3,000 or $4,000. And if it wasn't the first thing that he asked me when he saw the sheet, he was like, did you buy any of the furniture? No, I didn't. You like, it was all given to you like third hand? Yeah. Would anyone pay you $1 for any of the furniture in your house? No. Okay. No, I didn't scratch it off. It's like, it was already low, now it just got lower.
How would you value that stuff then?
Huh?
How would you value it?
Yeah.
Is it like, say it, you know, like.
Fire sale.
Oh, okay.
I think on a home furnishings, jewelry, car, anything that you own that is in that category, I think you like exercise the discipline to attribute the fire sale amount. Okay, but like, look, people have. I won't call anybody out on the spot, but Cameron, I bet your shoes probably have a decent dollar amount value to them.
Oh, yeah.
My brother, his baseball card collection is on his personal financial statement, and like, it's not like $500, right? A friend of mine who is a financial advisor collects Michael Jordan basketball cards, and I had no idea like how good the value is. It's almost like cryptocurrency in a way. So it's not just low dollar amount things necessarily that are personal property. And then you got the big one, the personal home or a rental that's in your name. So if you own a house that you live in, you would put that value here. The reason I clarified rental in your name, I get this question a lot. If it is owned by Mark Nottingham, it's going to go on my personal financial statement as real estate. And I'm going to attribute its value. I don't own any investment property in my name. I own investment property in LLCs. Where does it show up on my personal financial statement? Capital stock investments, which is one of a couple reasons that I think if you own investment real estate, eventually it is worthwhile to put it. There's a liability reason, there's a tax reason, and there's an accounting reason to do that. This is the accounting reason to do that, so that, for me, it's Nottingham Properties, very creative name, LLC. So on my personal financial statement is Nottingham Properties LLC. And then what number from Nottingham Properties LLC am I putting here?
Total balance sheet.
Yeah, total for the balance sheet. One balance sheet feeding another. So whatever my shares in that, I own that company with my brothers, whatever my shares in that company are worth in equity dumps onto this right here. So I don't have to list out addresses. Now, when a banker looks at this, and they see Nottingham Properties and a dollar amount attributed to it, what are they gonna say?
Let me see your balance sheet.
Let me see the Nottingham Properties balance sheet. Where does that come from? And how much validity do I think it has?
And your cross, actually.
Yeah. So what this does though, is it can, I think in a relatively discernible kind of neat way, package your financial assets. So you can see what the total dollar amount is of your financial assets. On the debt side, what you owe, your liabilities, unsecured loans, unsecured just means there's no asset backing them up. Credit card debt, student loan debt, medical debt would go there. Notes payable, this is money owed by you, could be to like, typically, it would be on like a family thing or something that wasn't necessarily like a formal loan, but something that you know that you owed. Or if you drew cash out of your LLC, you would owe your LLC money. So you would put that there as a note payable. Insurance loans, secured loans, taxes payable, real estate loans. The secured loan, they're most common to be a car loan because real estate loans are going down into that real estate loans category. Not many of you would have insurance loans or taxes payable. Hopefully you don't have taxes payable. It's never a good position to be in. Real estate loans, obviously, are big with your mortgage. You could have a second mortgage or a home equity line of credit. Again, if you have an LLC that owns your rental properties and you have a mortgage on those rental properties, it's not showing up here. That debt was already accounted for when the total equity of that LLC was calculated to drop in here. Okay? So this is just you as an individual. What is in your name? Other liabilities, I think pretty much what any of your liabilities would be, but just basically anything that you know you owe. Okay? Now, so I referenced earlier about the 22 to 30-year-old in the United States. Like one of the reasons people don't want to do this, because they know it's negative, because they know I'm not even totally sure what the value of everything I own is. I just know that it's less than my student loan. So I'd really rather not see a negative number. Or maybe it's not student loans and the number's not going to be negative, but it's still like you feel like it's small or relatively small. Start somewhere because this becomes a critical piece in terms of being able to grow that network. So if the main purpose of this, I would suggest the main purpose is this. It's the ideal basis to make future business and financial decisions because it does these two things. Helps you break out of what I think is a bad way of thinking or a limited way of thinking into a more advanced way of thinking about money. So because it does these, then it's the ideal basis. So I'm saying that the main reason is for decision making. Somebody give me another thing that now that you've looked at this document, I actually just kind of referenced it. What's another thing that this document helps you do?
Plan for retirement.
Yes, it does. It is a big, we're going to come back to this. It's going to be an action item for a number of you, but I think it integrates really well with retirement. I would categorize that into, if I could go back and change this, I would say financial. And then it would probably encapsulate the retirement. Something that's not in decision making. Maybe I could ask this in a different way. I have to send this document to a certain group of people on a regular basis.
Lenders.
Yes. Borrowing money. If you finish this class and think, boy, it really sounds like Mark is You must not like Dave Ramsey.
You don't, but.
That's okay.
I don't.
I do, yeah.
I probably am generally pro-debt and anti-budget, but I don't want to instill that, because that's, I guess, a decision I've made. Leverage is an incredibly powerful tool, and we're gonna go over that later. When you get a mortgage for your primary residence, yeah, I mean, you have clients do this all the time. Do lenders ever ask for this? Ever is the wrong word. Do lenders generally ask for this when you're getting a mortgage on your primary residence? Christy's saying, no, you are correct. No, why? What do they ask for?
Your bank statement.
Bank statements, W-2s, tax returns, all of those show what? Your income. Lenders will lend on primary residence based upon income. If you decide that you're gonna build wealth by investing in real estate, which is a case I'm going to make to you later, your income won't work, nor should it. The lender is gonna make that decision based upon the income potential of that property and this. You have to start somewhere. So think about that for a second in terms of how we talked about the two different ways of looking at money. Kind of the way we're conditioned is how most mortgages happen. I, as the lender, I want to make sure that you can meet your monthly obligation. Are you making enough money every month to pay the debt that you owe me? There's certain math there, it's a reality, but it fits the narrative of how most Americans think about money. The mortgage is the biggest debt that most people have. Student loans catching up, but there's even worse debt. But this is a document that really can eventually push you into another level of being able to utilize leverage. And you're going to have it, at least if you want to invest significantly. You could buy, if you've been, say you've been a realtor for 5 years and your tax return always shows a certain dollar amount of income, you could probably go buy an investment property and put it in your name. And the lender's gonna say, I know you can afford that house and your primary residence based upon your income. Follow that? But that runs out really fast. The other reason, and we're gonna hit on this in tax strategy before we finish today, I have now a rhythm of every fall, I call my key banking relationships and I have a conversation with them about what they're going to need to see on my tax return. This is a good example as to basically what I'm saying to them is I know and you know that you're primarily going to lend against this. But, yes, my tax return matters. I just need to have a conversation with you about what you need it to say. Why am I asking them that?
How do you deduct, what do you deduct? Income?
Right. That I know I have control over what my tax, legally, we're going to talk about this, I have control legally over what my tax return says, therefore how much taxes I'm going to owe. And I know the lender's going to care about it. Do you see how this document is, it's not just giving me power to utilize leverage, it's also actually giving me power to be able to enact a better tax strategy. Do y'all see the connection here? Right, so I know the lender has this, and so they're gonna say, which, I'll circle back to this, but a little bit of an aside, y'all remember, our previous president would not release his tax returns. He's very open. Do not make this conversation about Donald Trump. However, he's Why is he not open about his tax returns?
You don't pay no money.
I actually don't even think it has to be that it's illegal, it's that he knows they show zero. He's building an incredible amount of wealth every year. He's probably never, in years, has not paid income taxes. Whether it's legal or illegal is for the IRS to decide. My point is that it actually could be legal. Illustrates the strength of this document. Now, again, it's all relative. Like maybe I shouldn't even bring up someone who is a, whatever, multi-billionaire. You're like, well, that's just this different category. But if it's the difference between you owning one investment property or owning 10 over the course of, say, 5 years, oh, that's life-changing. It's legitimately life-changing. And this could be a part of it. So it's not just the decision-making, it's also that it gives you power to have options that you might not have had otherwise. And you might as well do it now, rather than like, I might as well just wait until I have some of the cash, and then a banker's gonna ask me for this one day, and I'm gonna have to create it. No, don't do that. Do it now and stay on top of it. Questions on the personal financial statement? Like, I think a lot of you are probably thinking about, like, would I put this on here? Where would this go? Yes, Chris?
So are you saying we should do this like once a year? Is that good enough?
Yeah, good question. I would say once a year or anytime you have a really big financial event. Once a year is probably sufficient. If you sell your house and buy a house, go in and change your financial statement. If you buy a car, something like that. If you pay off your student loan and you want to go in and declare it zero, that could be fun to do. Once a year financial event, or if you're trying to get an investment loan and a banker says, this was 9 months old, you need to update it. But you don't need to do it regularly. No, once a year is good.
And my last question, you were talking about the LLC for like rentals. Were you saying putting that where the corporation is or capital gains part?
Yeah, so cash, notes receivables, money owed, capital stock or investments. So you can list out companies that you had interest in. So this would be, it's obviously a lot different, but like, if you go out and buy a duplex in an LLC, you have to establish a balance sheet of the LLC. You then determine a total equity number in that LLC that you're gonna drop into here. And if you own $10,000 of Tesla stock, it's gonna go here. They're very different things, but they're on your financial statement, they're actually the same, because it's interest that you own in a company.
But if you are an S corp, that's where that income comes in, because if you're technically an S corp, then that would put the income that you paid yourself. So
No.
your S corp, is that what that S corp stuff is?
There's some stuff on the backside.
On the backside.
Okay, yeah, thank you, Crystal. Backside here, so think bottom of the financial statement where it says income. Income is totally separate. This is how much money are you making and where does it come from? I updated my financial statement recently and I noticed that my income had shown zero. And I'd sent this to bankers. I don't know how many times I'd sent it out, my income showed zero. So most of the time, I don't think people are looking at this because they're also getting my tax returns. So they know income and where it's coming from. But yeah, I think it's here as a means to say like, well, okay, if you want to put it in here, but you could leave the income blank. And this document still does what it's supposed to do. Where your income would eventually impact this. If you set up an S corp and that S corp had you had a really good year and you had $200,000 in revenue that went into the S corp, but you only paid yourself $150. Okay, your income was 150. What happened to the equity in that S corp? It went up by $50,000. But you would know that by looking at the balance sheet of that S corp, which is a capital stock you own here. Good question. Other questions? You can get specific.
So even though this is personal, there'll obviously be some things that like, I have a mortgage with my husband, so like, there's things that will go in here that aren't necessarily just individual.
Yes.
Okay.
Yeah, if you're creating it, so there's no better and worse here, but just to give you an example, like, my wife and I don't have any assets and liabilities that are separate from each other, so on mine, it's both of us, and everything's the same. But in my example, I did reference, like, I have interest in LLCs, that I don't own the entire LLC. I own some percentage of it, so I'm calculating that percentage, only my percentage goes here. So if say a married couple was going to create separate financial statements because they treated assets and liabilities separately, if you were like co-borrower on something, I would ask my banker, how do you want me to show this? So that you were on the same page. Because I think I would put half of the mortgage if I was truly treating everything else separate. You see how you couldn't use half of the mortgage and all of the value though? Right, you want to do the same principle. Yeah. Somebody, yeah, Andy.
Yeah, so, I don't know, I just like some of the, like the rich dad, poor dad, you know, folks talk about, your personal property as a liability instead of an asset. Which seems very backwards to me in a period of time where things are appreciating so much. I mean, it would make sense to me in like 2008, but it doesn't seem to make much sense now. I'm just curious what your thoughts are.
Yeah, there's a school of thought that I understand, I think, and it makes some sense that an asset's only an asset if it has the ability to make you money. That a home should be thought of as a liability, because not necessarily because of debt. You don't have to have debt to have the house. What do you have to pay?
Maintenance and what?
And taxes.
And taxes.
Taxes usually being the big one. That I think that school of thought is trying to exercise discipline. Remember how I said about the equity you have in your house on average for an American is about the same as their net worth? That school of thought would then say most Americans have no net worth. And I like that line of thinking because you see how that kind of forces your hand to a little bit more discipline in terms of, yeah, how can I leverage my financial statement if the only equity that I have is in a house that can't make me money? Now, it can appreciate. But typically homes don't appreciate enough to cover maintenance, insurance, and tax liability, let alone debt. So I get it. I think for the average person, you put it on here. Sorry.
Well, especially if you send it to the bank.
You put it on here because it is where a decent amount of your equity is. And for example, remember earlier I was talking about the realtor that owned a house outright with no debt. They had a vehicle that showed up on their personal financial statement to utilize leverage to make better financial decisions. And so I think that's an example of why I put it on here. I see this a lot in the like real estate investor podcasts and YouTube videos, and et cetera, where those kind of harp on the like, your house is a liability. Yeah, I get it. But I feel like, okay, if you own 100 pieces of real estate, fine, take your house off of your personal financial statement. But most of us, I think, should have it on there.
Now, we put the value of our home, fire sale now, the real estimated value.
Yeah, I think on a house, something that big, you do the real value. Yeah, yeah. Here's actually, we'll get into this. with the tax strategy and investing in real estate, we're gonna talk about the ability to, with investment real estate, you can depreciate investment real estate. And because of that, you know, I said earlier about like if you have an LLC, you just take the equity balance of that LLC and you drop it onto your financial statement. It's actually not quite that simple, because in your LLC, you can depreciate the value of the house, which saves you taxes every year, even though the house is going up in value. So like what I do, we actually maintain two different valuations. There's book value, and then I let bankers know, like, here's what we believe the actual market value, even though the balance sheet shows that property is worth $50,000, you and I know it's worth $100.
Right.
So I wanna make sure it shows up on this as $100. But yeah, that is actually a good example of how this and your income and the other company's balance sheet all interact in your ability to borrow money. Other questions on this? Not done talking about it, we're gonna come back to it, but. Okay, so I wanna, no shame, show of hands. How many of you could email a personal financial statement to someone today?
Apparently I could.
No, within a couple hours, yeah. And I really was just curious. I do, so, those that don't have one, this is gonna be, one of my challenges to you in these 2 days is, even in the act of creating the document, you are encouraging your mind to think about finances in a different way. So, as much as I have the ability to require it, I'm required. I don't have the ability to require somewhere else. But I'm gonna try. Okay, let's do this. I'm gonna push one thing into our last session, which means it's 3:15. You have until 3:30. 15 minutes. Cool?